to talk about setting assumptions and the process for setting assumptions for long duration products, including term life insurance, whole life, long-term care, and disability income. So this is the actual text from the accounting standard update. So the actual guidance that's on the discount rate. I'm going to draw attention to a couple items here, and we can unpack this a little bit. In the summary of the accounting standard update, the goals are to remove company-specific items and remove judgment. The first paragraph mentions upper medium grade, low credit risk, fixed income instruments. If you go to the Moody's Investor Services website and you look up a single A rated bond, it uses those same exact terms, upper medium grade and low credit risk. So there's a consensus to use a single A rated bond yield for a discount rate. So it no longer matters what a company actually invests in. If a company buys a grade below single A, Baa in Moody's or triple B in the S&P ratings, that doesn't matter. We still use a single A rated bond yield to discount. So the level of credit risk to reflect in the discount rate is basically prescribed. If we look at the middle paragraph up on the slide here, the duration is prescribed too. The paragraph says to use the duration characteristics of the liability. So say if a company invests in assets, longer than the term of their liabilities to take some duration risk and, in an upward sloping yield curve, they could pick up some extra yield. LDTi doesn't actually stop anyone from actually taking that duration risk, but it does stop us from using the extra incremental yield that comes from that duration mismatch in the discount rate. Now, the third paragraph says to maximize the use of observable inputs and minimize the use of unobservable inputs. The discount rate can be a single A, yield curve, meaning, there's a term structure over time, so a different yield depending on maturity, or it can be a single equivalent rate. The yield curve has a slight advantage if the liability duration is different than what we expect, that the methodology still holds together. There's not a right answer as to what period or curve or rate to use. We could average rates over the entire reporting period, or we could use rates as of the end of the monthly or quarterly reporting period. My own opinion, I happen to think the balance sheet is a snapshot in time. So if a company reports quarterly, the Q1 balance sheet is a snapshot at March 31st. So the March 31st single A yield curve is the right curve to use. Now I realize this, creates some logistical challenges and other issues, right? It's generally not available until business day one in the reporting cycle and can be challenging for some companies to implement. So I've talked about credit risk and duration risk are prescribed. Now I've worked as a consultant for a large number of companies, and I've also worked in the past as an auditor. There's a wide range of actuarial practice out there. So I'm going to ask you listeners, have any of you out there ever worked with somebody who sets assumptions a little aggressively? Well, let's think of a name. Let's call these actuaries line challengers, right? They don't want to cross the line and have anyone see that their foot's on the wrong side of the line, but they might go right up to close to the line and trying to stand this far away from it. If your line challengers are out there viewing the webcast today, you probably know who you are. If your assumption setting has the potential to be used as one of those case studies in professionalism at an SOA meeting where the attendees are split 50-50 in the poll as to whether the actuary acted properly, that could be an indication. If your company uses captives insurers, that's very common. But if the captives themselves have captives, well, then you might be a line challenger. For your line challengers out there, the interesting piece is that there are other risks on the asset side of the balance sheet besides credit risk and duration risk that are kind of prescribed in the guidance. There's liquidity risk, there's prepayment risk, and convexity risk that are not prescribed. So say there is a specific liability characteristic, like you have a liability that's not liquid, like a traditional long-term care without doesn't have a cash surrender benefit. That kind of comes to mind. The policyholder doesn't have a great deal of liquidity. If this liquidity is backed with an asset that's less liquid, there might be some room there to reflect the illiquidity in the discount rate. Now, the issue with illiquid assets is that, they're hard to get market value quotes on. The guidance on the slide before this one said to minimize the use of on observable inputs. But there are brokers out there that specialize in private placement bonds and mortgages, and it's possible to, there are rating agencies that'll rate these instruments and give them a comparable rating to single A, and it is possible to construct a yield curve with the information and quotes that they have. Another thing we want to think about here is that with U.S. Treasuries, if we create a yield curve with maturity on the X or horizontal axis and the yield on the Y or vertical axis, we get a curve that's usually upward sloping, but not all the time. For insurance company sized transactions, the yields for a given maturity, they fall in a given range that's very narrow. If you see Treasury quotes more than a few basis points apart, it would indicate that there's two prices for the same asset in the financial markets at the same time, and that's unlikely. It doesn't happen often. A more likely explanation is that the data you have isn't perfect. So usually Treasury curves fall on a thin line. If we look at single A rated bonds, we don't get that result. We don't get that same result. A little bit of a problem here for us to solve. How do we construct a yield curve or get a discount rate out of this, right? Give you some background information on this graph, right? I've got the yield on the y-axis and the term to maturity of the bond on the x or the horizontal axis. One of the validation steps I use when I model an asset portfolio is to model the term to maturity of the asset on the x-axis, just like, and the yield on the y-axis, just like this. And this is the market yield, the yield taking the current market value and on holding the bond to maturity and looking at the cash flows, what yield do you get? And we plot every observation as a dot on the graph, or another symbol, an asterisk or something like that. This is called like an XY or a scatter plot. And what I would do is do every different bond of every different bond rating. And the different bond ratings I would represent as different colors. So what you get is, since different bond ratings affect the yield, the riskier bonds get a higher yield. What you get when you do this with all the bonds is a range. If you represent each bond rating with a color, you get a rainbow pattern, right? So the different color bands represent different bond ratings. And if there's outliers, we can see colored spots that are out of place. They're in the wrong band, right? We can see some isolated colored spots, just like on this graph. You can see some dots that are above or below the rest of them. There's a couple things we can do to if we see those outliers, we can try to dig into things a little bit and validate the model. Now, this graph is the same concept of what I'm talking about, except there's only one bond rating. So, sadly, there's only one color on the graph today. But the issue is that unlike a treasury, it's not a line. It's this fuzzy band that we see up here, and we want to use observable input. Remember, so is a single A rated bond observable? Well, the answer is yes. Sort of, right? What causes the width of this? Well, single A covers a range of credit risk, right? So there are sub ratings, right? They could be a bond could be rated A1, A2, or A3, or different rating agency, A plus or A minus, right? There's also other risks besides the duration and the credit rating that we've talked about already. Now, you line challengers out there, you can't just take a pen and connect the dots along the top of the curve. Right. The rest of us, right, if you're not a line challenger, you can't just draw a line down the middle of the curve either, right? This process is subject, this is GAAP now. The process is subject to controls, and it needs to be consistent each quarter and each reporting period. So we can talk a little more about how to get the line later, but we could make a justification for using something closer to the top of the range I've mentioned if there's a liability characteristic like liquidity. The key words we want to remember in the guidance are just reliable information and observable input. What I haven't talked about today, because there's a great deal published about it already, and there's a lot of good literature, actuarial literature about it already, is what to do if liabilities are longer than the term for available assets that are observable, right? So the right side of my graph cuts off at 30 years. Well, there's some white space off to the right. What if the liability has cash flows out in that period? And there are a lot of good published methods to address that. So I haven't talked about it today. Now, it's necessary to recalculate the discount rate each reporting period. And we need to do more than one run for the discount rates. We do a run using the original discount rates, then we do a run using the current rate. And the difference in that liability doesn't flow through directly to the top of the income statement. It goes below the line to other comprehensive income. So the change in accumulated other comprehensive income is changed to reflect the difference of the two results. So this slide represents a typical process a company might go through to set the discount rate each period. The first step is to collect and analyze the observable input. It might look like the graph we had up on the prior slide. If it does look like that, the next step is to fit, smooth, and develop the observed yield curve or rate. We need a process to take that blotchy band of blue dots from the prior slide and develop an assumption, either an exponential curve fitting or a nonlinear regression. Once that's developed, a company can create and follow a process for review, recommendation, approval, and finalization. Assumptions that are not the discount rate are called cash flow projection assumptions under LDTi. These assumptions are all based on estimates of future experience. And if we have changes to these under LDTi, these go above the line and directly impact the income for the current period. Now, the accounting standard update 2018-12 that LDTi, it's 193 pages long, but it doesn't give us a lot of guidance for assumptions. So for our mortality, we do include mortality improvement and future mortality improvement to the extent it's part of the estimate for future experience. Morbidity and terminations, there are some breakdowns given that the assumptions can be grouped by. Like the guidance gives examples that you can break down terminations by plan, issue year, premium mode, and other factors. And it also says you can do that, or you can use an aggregate rate. For morbidity, the guidance is a little bit more prescriptive. It says to vary the assumption by contract type, class, gender, age, and benefit period. So it's a little more prescriptive for morbidity. Also for terminations and lapses, products that don't have a cash surrender value should still have a termination rate. That includes lapse supported products. There are a couple of big differences from current treatment. For expenses, the treatment is different than current GAAP. So the only expenses included in the liability for future policyholder benefits are the ones related to benefit administration, like expenses related to processing a surrender or a claim settlement. Maintenance expenses are expensed under LDTi. All of these assumptions on the slide together so under LDTi, our process needs to change. Previously, assumptions were locked in. The process for getting best estimate assumptions was only used for loss recognition testing. And in my view, my experience, it was not subject to a high level of scrutiny. Under TI, it's kind of like we're unlocking every period. We need a formal process to set the assumptions. And again, I see a wide range of actuarial practice, study on kind of a spreadsheet with a couple numbers in it, and it might be hard for somebody outside the company to follow, or someone not familiar with the spreadsheet to follow. But then I see some experience studies done in a very formal written study. I've seen company studies that rival what the SOA publishes for an industry research report, right? So if your experience studies are done in a spreadsheet and not at least a formal written study, maybe they need to move a little bit in that direction. Under LDTi, they should be something that somebody from outside your organization, like an external auditor, could pick up and understand and follow the process. There's one key piece of guidance that says to review, and if there is a change, update the assumptions used to measure cash flows at least annually. Now that one word right there, at the beginning of the quote, review, well, that means a lot of work. It means we need to have a view of our assumptions, how our experience, the assumptions, and how the experience compares to what's, in how it compares to that are in the models now, and how, basically how it compares. For a company, it probably means they need to update their experience studies regularly, a minimum of annually on the standard, but they also need a view as to how their emerging experience from each reporting period compares to the assumptions in the models used to project future benefits for reserves. The minimum amount of work that we need to do for a company of any size is to compare our actual experience to expected experience. So there are disclosures that require this. We talked about lapses in morbidity grouping of assumptions by liability characteristic. The breakdown on this slide is a different type of breakdown. These are breakdowns of actual versus expected. What it means for companies is that assumptions are going to be much more granular than they were before. The actual and expected experience need to be available at the levels that DAC is grouped and the levels at which reserves are calculated. There's a requirement that the DAC balance be reduced if actual terminations exceed expected terminations. There are also disclosures that require the comparisons as well. This is the type of information needed, or one way of complying with the new disclosure requirements. Let's pretend it's April 2023 and we are doing reporting under LDTi. This is for a term life product. This is a hypothetical for Q1 2023, so that there are 2022 issues here. It's a newer product with recent underwriting and low mortality. Now, I use the word cohort to represent a grouping. The new terminology in LDTi for cohort is the level of aggregation at which reserves are calculated. I can't quite fit that in the box in the slide, so I'll stick with cohort. Anyway, each row represents a level of aggregation at which reserves are calculated. The top left portion has starting values, policy count, face amount, and premium. If I look at the top table of numbers in the total row, there's 111,126 policies at year-end 2022. When my reporting period for Q1 2023 starts, the average policy size is about a $250,000 face amount. The face amount is in millions. The total face amount is just under 28 billion, and my total premium is 16.67 million annually. I'm showing that as an annualized premium measure, as an in-force. It's an in-force statistic and not a cash flow item. The top right side shows expected lapses and deaths. The bottom left shows the actual ending amounts. The bottom right shows the actual lapses and actual deaths. So there's a relatively fine level of granularity to split the experience into, the actual experience and the expected experience. There's some work to do on both the IT side and the actuarial side to be able to produce this. This is a piece of the new disclosures needed. It is not complete. There's other information about these policies that need to be disclosed as well. The expected lapses and deaths might be a little easier than it looks. Most actuarial software will produce a policy exhibit and an equivalent exhibit for face amount and premium. There's a starting amount that rolls forward, then it has decrements, then it shows the ending amount. Well, software gets the expected decrements by applying terminations and mortality assumptions. So if you put the GAAP LDTi reserve assumptions into the software and run a projection, the software will calculate the expected decrements for us. The guidance on a prior slide said to review assumptions at least annually, and if there's a change, to update them. Well, this is a block of relatively new term insurance. I'm going to round the numbers for my example, but the expected deaths here are 22.91 out of 111,000 policies. So my QX is about 0.2 deaths per thousand. Excuse me. My P, or probability of survival, is 0.9998. So the mean is 22.91, the expected number of deaths. The standard deviation, if you remember our binomial distribution, the square root of NPQ, it's approximately 5. So with 24 actual claims during this period, I'm right in the fit part of the distribution, really right where it should be. And there's not enough information up here for me to change my assumption. If there is a mortality study that led to the mortality in the model that leads to the model projecting the 22.91, and we updated it with this new data, maybe not every quarter due to the low materiality of this experience, but if we did this annually, do the estimates from the study change at all? That's what we need to think about. The accounting standard update gives an example where there's a small amount of deviation and the company decides not to update their assumption. Then the example continues and they turn out to be wrong 3 years in a row, and then they do decide to update the assumption. Now you might notice here that the level of observed terminations, especially the deaths with 24 actual, don't give us a high level of statistical credibility. Even if we extrapolated this to a full year, we'd have something like 100. It's still not a high level, but we still need to review company experience to determine if the difference between expected and actual is due to the assumption maybe needing to be revised or due to a statistical fluctuation. We'll discuss that a little bit coming up. If you haven't noticed by now, well, if you're setting assumptions under LDTi, you have the opportunity to learn or relearn some mathematical processes. These are the kind of tools I like to keep around. Continuing from our discussion on the previous slide, we had 24 claims. Standard deviation was 5. We need more than 1 quarter of experience to really draw any type of conclusions about mortality. The credibility theory that's published in actuarial literature is in the context of mortality table construction. It's not about revising assumptions for LDTi. So we really need to understand that a bit and revise it and adopt it for our own purposes. That context of credibility there is, a little bit different. We want to be building a mortality table. You want to be able to say things like mortality will be within 5% of the value predicted in the table 95% of the time. Well, if we call that full statistical credibility, a 95% chance of being within 5%, it depends on the actual numbers and the mortality rates, but we need about 1,500 claims, observed actual claims to get there, right? And that context is not the right one to use for LDTi. If I set a mortality assumption and the emerging experience tells me that I'm 95% sure my mortality is wrong, am I going to change my assumption? Of course I am, right? But what if I'm 51% sure that it's wrong? The line challengers are all up there. They're all up there saying, no way. There's almost a 50% chance it's right. I'll try to make 2 key points here, right? I don't need 1,500 claims to know that I have a 51% chance of being wrong. I can get a higher comfort level, a higher confidence level that my assumption needs to be revised by just observing a small deviation from expected. If you actually work through the numbers and work through the credibility theory. Second point is for us to establish a context for setting assumptions now and set up a process. We could say, like for mortality, that like we've been talking about, a process might, at a high level, it would look like, we could say that, hey, we're going to look at this historical period and define what this historical period is, and whether it includes the current quarter or whether you do it a quarter in arrears to save time at when you're doing your reporting for the current period. And I shouldn't say quarter, whatever your period is, quarterly or monthly. So we're going to look at this historical period. We're going to pool these products together. We're going to calculate our standard normal z-score, and we're going to change our mortality assumption if the z-score is outside of a certain predefined range. Right. So if we set that as a context for setting assumptions in advance, then it's easy to figure out what we're going to do when we actually get to 2023 and we're reporting under LDTi. We want to put a process in place now and try fitting it for past data to develop these parameters, and if necessary, negotiate with the auditors before the date we move to LDTi. There's some other types of high-level math For the discount rate, the single A yield curve is usually not linear. It's a curve. So to make a line out of all those dots in the graph I showed you earlier, a curved line, we can't use linear regression that we all learned taking actuarial exams. We need to use a more advanced formula fitting technique. Polynomial regression is probably the most straightforward way to have a repeatable process that'll give us an assumption we can use. There's other methods like fitting it to an exponential curve, but it's something we want to think about, well before our implementation of this standard update. I mentioned rejection tests on this slide. Now, I'm not talking about what some of you may remember, hypothesis testing, where we can accept or reject a null hypothesis and be 95% sure. I'm talking about if we have that slide full of dots that shows the single A rated curve, and we have an observation that's an outlier. So say we're setting our discount rate and looking at the XY values for a yield curve. We're looking at observed values, and it looks something like the band of dots, and we see a dot that's way above or worse, way below the others, and we think it'll influence our nonlinear regression curve fitting. One way to deal with that is to do some research on it, right? Go see where the bond quote came from. Maybe the market value was stale that went into the yield and not really applicable to that period. So you could try to research it that way, and if it turns out to be unreliable, we're not supposed to, we're only supposed to use reliable information. The standard says, so we could throw it out. But maybe you don't have the time to chase down the investment department, on business day 2 or whenever you're looking at this curve, right? There's another way. There's a statistical test called a rejection test that allows us with some specified level or prescribed confidence to remove an outlying observation while we're doing the curve fitting. Remember, the accounting standard update says to use reliable information. If we're 99% sure or 95% sure an observation is bad, then it's easy to say it's not reliable, and we're gonna throw it out. And there are published tests that allow us, methods that allow us to do that. The point I can make here is that there are these tools and others. I put these into the framework for LDTi in advance. Anyone ever have a plumber, electrician, or repair person come to their residence? Well, they've got a big toolbox with them and more tools in their vehicle. And looking at them can actually help us with LDTi, right? They know that it's a lot better to have a tool with them and not need it than to need it and not have it. If we need more data to set or perform our annual review of experience under LDTi. So, more than we have, right? For the term product I had, there wasn't enough to be credible. So we need more data. Company experience is probably the most valuable. In actuaries, we already know we can look at similar products, similar underwriting standards to try to get experience for a product we may be looking at. But certainly, anything we can get within the company has the most value to it. If we reinsure products, reinsurers have access to larger pools of information. They can help companies determine if their company experience is the result of a larger trend, or maybe just something that's unique to their company, whether it's part of a larger trend. There's also a large amount of industry data available, at the SOA and other organizations like LOMA and LIMRA and other research institutions. So this slide, it compares assumption setting under 3 bases. The first row is, accounting standard 944-60-25-9. The key number there is 60. This is the standard that's formally known as FAS 60, and it's codified. So it's GAAP before LDTi. We use the best estimate assumptions plus a pad. They're locked in with an asterisk, and the asterisk means they're locked in unless your projection falls apart, and things aren't, DAC's not recoverable, or there's other issues in the projection, and then they're unlocked. The second row is statutory valuation, so U.S. statutory valuation for life products under VM 20, and the third row is LDTi. VM20 uses anticipated experience, which is another way to say best estimate. Plus there's a separate margin added to VM20, so it's anticipated experience plus a margin. LDTi just uses best estimate. So, question is, should our best estimates for LDTi and VM20 be the same? Well, usually yes. VM20 has prescribed experience periods for things like mortality and more things prescribed overall. So there could be a difference if the company views, one of the rules of VM20 with it's not being consistent with their true view of estimated future experience. So there's room for differences between those two sets of best estimates, as long as we understand why those differences arise and we're able to explain why why there are differences. One difference for LDTi and VM20 is for mortality. So under VM20, no future mortality improvement is allowed, and under LDTi, it would be included to the extent it's part of the view as of future experience. And LDTi requires an annual review of assumptions, and VM20 only requires a view of mortality every 3 years. So under LDTi, our assumption setting process needs to look different. What needs to change? Our experience studies need to be more granular. There are more disclosures. We need to show actual versus expected. Our processes for assumption setting and review need to be consistent from period to period. When we need to formalize the process for assumption review and sign off, and formally state the criteria for approval and moving to final values. Oh, and there needs to be controls around the entire process. We need to apply controls to the data setting process. Excuse me. Data files, collection, and validation. Our experience studies should follow actuarial standards and be peer reviewed. The process for assumption review and recommendations needs to be documented. The question is, who does the review? What specific items do they check? Who does the review as an alternative if the person who's supposed to do the review is out of the office, right? We need to think about all of this. And the approval process needs to be documented and have controls applied to it. So if the process for our assumption approval now is to have the VP and actuary review and sign off, well, we need to document that. We need to interview that person, get them to write down the criteria they use, put this in the documentation. Think about what to do if they're unavailable, if there's a job vacancy or illness, whatever reason, right? Who's their successor in the event that they're not in the office to be able to do that. How does the new way of setting assumptions impact our products? Well, I'll apologize lightly for the subtitle on this slide, but how does long duration targeted improvements impact long-term disability income, long-term care insurance, and life products? Bill had a point up on one of his slides that the value of assets and liabilities should reflect their intrinsic value. There was a time when the discount rate on the liabilities would be locked, with an asterisk, and the assets could be marked as held to maturity. Under that held to maturity designation, the yield would be the same over the life of the asset. The investment income would be uniform. If yields on renewal premiums didn't change significantly and there was not a need to unlock the interest assumption on the liability side, the investment income was very predictable. Well, LDTi changes all of that, right? Now the liability side is marked to market because the cash flows are discounted with the current single A rate yield curve. Now, if we wanted to reduce the volatility in accumulated other comprehensive income as much as possible, that may or may not be the goal, but for the moment, let's say it is. The best way to do that is to buy single A rated bonds that have the same duration as the liability, hold all the assets as available for sale, so they're marked to market just like the liabilities. That way, any change in the discount rate impacts the bond portfolio and the liabilities the same way, and this minimizes the volatility. So under LDTi, book value accounting is gone. So yields are kind of low right now. If companies take some duration risk and they invest long to try to pick up some yield, well, that adds volatility, right? Because now there would be a duration mismatch between the assets and the liabilities, right? That would, and a shift in rates, or non-parallel shift of the yield curve could just throw a difference into your other accumulated OCI. Well, will companies end up taking less duration risk to reduce volatility under LDTi? Well, that's a good question, right? For disability income, if the product has a level premium and a reserve builds up, then active life reserves are impacted by LDTi. Claim reserves or disabled life reserves are classified as short-term, generally by most companies, so they're not impacted by LDTi. On a group product where the premium could be increased by the insurer annually or set by the insurer, this is considered a short duration product. It's not impacted by LDTi. For long-term care insurance, active life reserves are treated the same as long duration, and the same guidance for LDTi that I've been talking about for the discount rates and the assumptions applies. Claim reserves for policies that have a limited benefit period are also usually classified as short-term, so they're not impacted. For a lifetime benefit, claim reserves for long-term care have characteristics of both short and long-term. So that's something long-term care writers need to work through. So the first step is to classify the liability and then apply the appropriate guidance. Interest in morbidity for long-term care are, the assumptions sometimes actuaries have been, historically, incorrect about for some in-force blocks of long-term care. So not only does LTC have a benefit that kicks in if someone needs care over a long-term period, that gives its product its name, but it's also long-term in other ways. It's long-term because the benefits occur a long time into the future. So that single A-rated yield doesn't need to move or shift very much to create a large amount of movement in the discounted value of benefits. So the accumulated other comprehensive income can move a great deal with a small movement in interest rates. As some of Bill's material alluded to, I think this new volatility will continue to drive consolidation in the industry.